Howdy, Jacob here. Today we're looking at advanced energy industries in the semiconductor and equipment industry. You're looking at 3.7 market cap on 3.6 billion enterprise value. They provide precision power conversion, measurement and control solutions in the US. Their growth has been very impressive, from 367 million in revenue in 2014 to 1.6 billion in 2023, and has been fairly cyclical, but less so than some of the other semiconductor industry companies that I've reviewed. One thing I do see is that return on invested capital is averaging in the low double digits, but has been in the 30% before. So I will look at this 2018 to 2019 if that was just an acquisition or whether they just, okay, so yeah, it looks like they did make a big acquisition and that affected their return on invested capital a little bit. And margins, both gross and operating, are both down quite a bit from 10 years ago. So I do like to actually see the opposite. I do like to see earnings grow more than revenue. That means the company is being more efficient with the use of cash that they have. And it just makes sense logically that a company is not able to grow their top line as much as their bottom line. They're going to be able to find different ways to minimize costs and put more money to the bottom line. And here we actually see their revenue is up 4 to 5 times plus, and their operating profit is up less than double. So just definitely something to note there. Income statement shows shares down a little bit, so they have repurchased a little bit of shares. They do have $1 billion in cash on hand and less than $1 billion in short-term and long-term debts. They have enough cash to write off their long-term and short-term debts, so not a concern there. Free cash flow through acquisitions, it looks like their capital expenditures have grown, and so they're that just means that they're likely purchasing companies or businesses that require a bit more capital than what their business was pre these acquisitions. And use of cash besides acquisitions is a small dividend that pays out 15 million in aggregate, which is probably about 10% of their 5-year average free cash flow. And then maybe 20% goes to share repurchases, with quite a bit going to the acquisitions. The thing I do like is their free cash flow has always been positive the last 10 years, whereas we were seeing on the income statement, we saw a big down year there and a bit more volatility. But I think I'm ready to start making some assumptions here. I'd say on the revenue growth side, through acquisitions, the reinvestment, I probably wouldn't be surprised with maybe a 6% revenue growth, maybe a market average P roughly of 16. Really just making some acquisitions isn't really reinvesting, and they don't necessarily have a historical rate of making those acquisitions worthwhile. I care about bottom line way more than top line. I care about free cash flow more than anything, and I just am not seeing that growth really be there. And with declining revenue or margins, let's do maybe 8 and 9 with share change. Let's see, stock-based compensation about 35 million. I think they can offset that, so I'll keep that flat. And the dividend currently paying out 15 million. It's pretty small, but they haven't increased that, so let's keep that the same. Maybe I'll say they make some more acquisitions to grow a little bit more. So basically, I was thinking about what the company would do with their excess free cash flow, and based on their dividend staying the same and their share repurchase just offsetting stock-based compensation, we still have 70% of free cash flow. So I just bumped the revenue up a little bit, meaning that they're either reinvesting in themselves a little more or making acquisitions to increase that top line number. And we're just saying with these assumptions, it does look a little bit expensive. So I do prefer companies reinvest at rates that they have well an extent of the market, and if it's greater than my discount rate, even better. But here, companies that are just a company that's just acquiring businesses, hitting the top line, not so much the bottom line, is pretty much what a lot of companies do with acquisitions, and it's not necessarily very advantageous for the the stockholders and shareholders. So I do hope you enjoy the video and have a great day. Thank you.